Hi, this is Derek. All right, so what I want to do is just give you kind of a quick briefing on some of the trades that we do in Oahu Capital's education program. So the first thing here is if you go to our website, it's over at oahueducation.com. We've actually got two websites, oahucapital.com, oahueducation.com. But the oahueducation.com really is the one that shows a lot of the different training education that we do have. So periodically, even on here on the front homepage, just a quick overview, is if you go here to news and markets, you can access the charts and a lot of the commentary that's on here. So just go straight here and you can see the various markets here, including, if you go down a little further, those here are the Asian markets. Okay, but what I want to start off with is if you go here to our watch list, periodically, every week or so, what I'll do is I'll update some things here with regard to specific trades. So certain ones I have here relate more to hedging, which is more institutional related stuff. But down here, for example, you'll see that we have something that's more of a speculative trade. All right, so here, for example, I have on gold the upcoming week. And what you'll see here is a start off. So this is Paul Forcione. I worked with Paul for a while. Paul was actually a floor trader on the Board of Trade in Chicago. He's also a market maker at CBOE, which is the Board of Options Exchange. He used to trade in the T-bond futures pit. So here on gold, if you were to scroll down, you'll see we've got certain ebooks here. We've got a series of 10 ebooks. These are more sophisticated trades. And a lot of people say, well, why is it should I learn how to trade options or options on futures? A lot of people say, hey, options are risky. I hear that a lot. Or, where they've tried things with options and they haven't done very well. And for the most part, I can explain and show people, probably why that is. A lot of things, for example, people that are very new or novices to options tend to buy, far out of the money options because they're cheap. And they don't really realize that the probability of those things, actually landing into a profit zone is very, very small. In any event, if you scroll down here, you'll see various different things in terms of the way we do analysis. You'll see stuff like, for example, here on the charts. Now, I've known Joe Napoli for a very long time. If you go to his website, you'll see where things like on the software for like Trade Navigator, he'll send people over to me to basically get them set up because I worked with the guys at Genesis for a long time. But you'll see here where we have various types of different technical indicators here. Okay, and with that, what I do is I show things in relation to options. So just for example, with the post there for gold, I have an illustration here where you have an area here at 1768, 1769, somewhere around there. You've got this Bollinger Band, but here you have the Fibonacci retracement analysis. You have the preferred stochastics. And in this particular illustration, and again, nothing I do here is a recommendation or an avocation to put on any type of trade. It's just mainly for education purposes only. But if, let's say, for example, gold were to fall down and you wanted to get into a type of trade here, you could trade, for example, CFDs in Asia. You could trade, gold on that, in which case, or the futures. But see, again, the problem that a lot of people face when they're trading the underlying asset is that, they typically can't weather the pullback. So if they were bearish in this case, for example, and they were trying to say, well, hey, I'll put a stop somewhere above the tops over here. For the most part, many people, have to trade very small. They can't afford the margin requirement that goes in here for a futures contract because that could be kind of big. Or they try buying put options, or they try selling calls, and they just don't have very much of an idea on how that actually works. If they're trying to make it down, let's say, to the center of a Bollinger Band, or even somewhere down here in terms of support, how do you actually play that? And the best way to do that, in my view, would be working with the options and option spreads. Now, why is that? Well, let me show you. All right, so let me do this. Again, this is all from our watch list on our website. And if you take a look at any of the pictures here, for example, and you were, for example, just to right click on here, click open image and tab, it just opens up a larger image for you to look at. Okay, so Okay, so here we're looking at a weekly chart, but let's say we were to drill down here to a daily chart. And again, you're looking to come down here. All right, so with gold, for example, every tick over here moves in 10-cent increments. So 10 cents times 100 ounces would be 10 US dollars for every 10-cent tick here. All right, so if you were, for example, again, just trading the futures and you were to just do the math over here, all right, and did the math of 760.40 or just above, let's say 761, you were looking to have a stop over here in trading the futures, and you were to enter somewhere over here around, say, 1707, how much risk are you actually taking over here? All right, so for my example here, I'm going to quickly switch over to the August contract, because when you look over here, you've got the volume here in the August contract. Okay, so here's an example of Trade Navigator, and just really quickly, since again I work with the folks over at the DiNapoli team, at Joe DiNapoli. All right, so what I'm going to do is just quickly go like this, and we'll just use the context of the August contract. So let's suppose over here, run on candles. Let's suppose you're over here, 717.26, and again you're looking to go down here near this level of what we call confluence here. Okay, so I know a lot of you technical traders use this for over here. And then in terms of a stop, you're looking to stick something above here, 1773. Well, what would that actually look like? Okay, so first off is when you do it mainly on, let's say, working with a futures contract. Okay, you can see here the margin requirement. This is actually more, if you look at the value, I think depending on the broker, it could be higher in terms of an initial margin requirement. It could be like 15,000 bucks for a one lot contract here. And I think this is probably more near the maintenance requirement. But if you were to look at that here, and if prices were to go higher up here, so we're looking, let's say above 1773-ish over here. Okay, what are you looking at? 1773-ish, you're looking at about a little over $4,600 on a one lot contract in terms of loss. And a lot of people can't weather that being mainly looked at on a daily chart over here. So then a lot of new option traders might say, well, hey, look, what if I buy a cheap out of the money put option to take advantage of that? So let's take a look at that. Let's say we were to go and buy, say, a 1650 put option. Okay, so what does that look like? So that looks like something like this, okay? And if we were, let's say in 15 days, purple line represents a one standard deviation, or about a little over 68% probability that price vacillates and falls somewhere within this range, right? So let's say we look close to about 1675, okay, on this. Well, what's that actually look like? So on a chart I dropped over here, 1675 looks like this here, just above this forecast level of support, so to speak, on Fibonacci levels. And of course you got your 1773 on top over here. All right, so what does it actually look like? This is where we're at. And what's the probabilities of this actually coming into fruition? Okay, so let me just take a quick step back here. So each of these lines here, I know most of you are probably familiar with how option charts are drawn, but each line here represents a point in time. So right now when you see this horizontal line here, this is T+0, this represents today. And if I click on this, this is 15 days later. And then this is at expiration, that heavy line over here. Okay, so if I went from, let's say, T+0, this line, and I just looked at, let's say, 15 days later, which brings me up to this area, this magenta area, of being about 68%, one standard deviation, that will be somewhere within this range. Okay, so what's the probabilities of making it down to 1675 on an out-of-the-money option? And again, this is a lot of stuff that people don't really look at or understand. But if we were to take a look at that, and I were to put, say, 1675, 15 days later on an option probability calculator, you can see you have less than a 20% probability of actually making it down here, over here, this area. Okay, you've got a higher than an 80% probability of being somewhere above that area here, in which case there's a higher chance you'll end up losing money by doing this type of out of money strategy. Okay, so a lot of folks don't understand or look at that. They just think, well, cheap, I can purchase this option at 840 bucks and we'll just go from there. It's cheaper than buying the actual underlying futures product on gold. Okay, so that's just something that I wanted to share with you real quick. Now, what are some of the other things that we could look at? So really what it comes down to in terms of a question is what type of strategies and what type of instruments could we use to best optimize our ability to play out this type of strategy on a daily chart. And a lot of folks, especially here in Singapore, we know that folks have a full-time job, they're working constantly, and trying to micromanage a intraday chart trading the futures can be pretty nerve-wracking. So one way of doing things is working with the options. And here, let's say, for example, we're looking at the same context, 1675, 1773. Well, what type of strategies could we do? So basically, on the watch list of our website, again, if you scroll down here where we have the charts we're just looking at, and over here's the tip where you could enlarge the charts if you want. But if you scroll near the bottom, you'll see the various types of strategies that I'm about ready to illustrate here. So let's say, for example, this type of strategy. This is what we call a vertical swap. And all of these types of strategies are in the books that we have here. And these are on our website over at woweducation.com. If you go here to the resources books, you'll see all the different kinds of books that we have available here. I'll show you that in just a second. But let's say this, vertical swaps, which is what this is over here. Well, how does this play out and why is it valuable? Well, let me show you. Okay, so this is kind of what it looks like. So this is a 10 lot. So this isn't a 1 lot. This is a 10 lot on the actual strategy. All right, and you can see here from the T plus 0 line and T plus 15 line, if we were to look at where we were taking a peek in terms of the parameters, this being 1675, this being 1775, you can see now where you're within this magenta area, this representing a 68% probability of falling somewhere within this range based on volatility of the underlying asset. So what this does when you're working with options is you're kind of working with more of a shotgun approach in trying to reach specific levels and minimize the amount of risk that you have on the outside. So if you looked at the context of our chart being somewhere above 1775, that's this tail end over here. And then, of course, look at where you're looking at in terms of loss here. This would be about $500 in relation to the amount of margin that you're putting down here. So again, as opposed to that larger chunk of margin being $12,000 with the futures, now you're looking at less than $2,000, and this being a 10-lot contract. All right, if I were to adjust this in terms of yield, you can kind of see what you're looking at in terms of return on margin. Okay, it's a fairly attractive return on margin. So these, again, are the types of things that we cover in our materials. So again, if you were to come here to our site, click on resources, and look at the various books that we have here, you can read more about Paul as well. In fact, you can even watch a video interview on Paul over at the Chicago Mercantile Exchange that he did. Yeah, I was actually with him. This was back in around 2011-ish or so. But you can see all the different books that are here. You can take a look at the table of contents if you want, see what these books are actually about. And you'll see that these are rather sophisticated strategies. So where many of you might say, well, hey, I really don't know much about options at all, that's fine too. We have some fairly basic courses that take you beyond just what the exchange puts out in terms of what's an option. We have crash courses on how to learn on putting these strategies to use. Okay, so just a quick heads up for you. Before I go into the other strategies, just to show you real quick, another thing that a lot of folks who are just new to options don't really understand is the impact of implied volatility. Now, what's implied volatility? Implied volatility can have a huge impact on the way options are priced. So, we always look at volatility charts when we talk about things in our books, and we reference that in terms of our courses as well. So as an example, if you understand how things work in terms of working with implied volatility, you're able to create structures that give you a theoretical edge. Now you can see here, and again, I won't go too far into this, for those of you who understand what Vega is, this is a negative $33 of Vega over here for every move in this trade where implied volatility drops by 1 percentage point. You're going to have an extra $33 on top of here. Okay, if implied volatility would rise, it would go $33 against you. So it's really negligible in terms of the impact of implied volatility here. Whereas if you were to look, for example, back at your put option, the out of the money put that we looked at, now you have $128 worth of positive Vega. So if implied volatility were to decline, meaning that the impact of implied volatility goes against you, well, you're going to end up losing $128 for every 1 point change or decline in implied volatility here. Okay, so let's say if I go like this, you're going to lose, say, 15%. So this is what happens, for those that don't really understand how options work. Okay, they go, well, I keep losing on the way I trade options every time I try. Well, there's a lot of education that goes behind it, and that's, again, stuff that we can do if you were to take a look at the materials we have on our site. All right, and these are some of the other structures. So this, for example, is an iron condor, and this would be, for example, a calendar spread. And one of the things that we show and illustrate in the course of our education is how to manage these. So if you're working, for example, let's say with an iron condor, which is more of a neutral trade, in other words, you think price is going to stay somewhere within this range of prices for gold, and you're just looking for time to pass by. So let's say this would be about 21 days here. You could earn based on just this range, and we show you how to, close out, exit, adjust, and adjust profits as you need. So my suggestion, if this is something you're interested in, is come over to our website at awalueducation.com. You can take a look at our watch list. This is all the stuff that we just went through. And then if you'd like to, go ahead and fill out this form here. Learn more. We can certainly give you more information on what it is that we do, and we certainly look forward to working with you. Take care. Thank you.